All right, gang. So in this course, we're going to cover standard deviation, the Wall Street Jack Boy style, okay? This is not a college curriculum class. A lot of people have taken statistics in college, and a lot of people had lots of issues and probably didn't even pass their statistics class. But one of those things that you learn in your statistics class is the standard deviation. It really doesn't mean much when you're doing it in college or school, but when you come to the options world, it brings meaning to the statistics. So it makes it easier to digest and actually easier to understand once you get it. So basically, in the previous class, I was showing you guys about implied volatility, standard deviation. These all go together. When I was talking about implied volatility, I was talking about behaviors, how people normally behave versus, other people. And the key thing to understand about that is that when you understand people's behaviors, you can kind of predict them, right? Like my roommate, for instance, I have two roommates that we used to live together. One was just radical. He was the high volatile friend. And then one was the low volatile friend. We can really predict what he was going to do. Like literally every morning he was routine. Every evening he was routine. In the evening time, he would, come from work. He would sip his whiskey. He would roll up some Mary Jane. He would go to sleep. Pass out. He played a video game and he could pass out. And that was every day like clockwork. So if he did that 365 days of the year, then today, if we were living together today, I would be able to predict what he was going to do that evening. Doesn't mean I'm a psychic or anything like that. It's just what the normal behavior is. I can actually predict that, right? And so versus my other friend who was volatile, you didn't know what you're going to get. Some days he was, calm and, collective. And then some other days he was just radical, right? So it's harder for me to put a number on that guy. But this other guy, I can predict that. So if I can predict that, then I can make moves. So the stock market, it works the same way. So with the standard deviation, it's going to allow us to see how these stocks, they normally move in their normal distribution. Just to give you a brief demonstration, we'll go to our charts tab here, and I'll show you how to do this so you can see it. We'll go to edit studies, and then we're going to type in standard deviation channel. We'll click that. We'll add selected. We'll bring it over, hit apply, hit OK. All right. So when we talked about the implied volatility, we talked about volatility. It wasn't about like a certain direction. It's like a direction up or down. So it's including up and down behavior because, again, the action is up or down. So this deviation channel, standard deviation channel, actually shows us the range that these stocks normally behave in, right? And its normal movement, its normal path should be in here. And there are times that the distribution is abnormal, and so you go to higher deviations. So if we go to, I just click the edit study strategy. We go here, we can see everything that's on this chart. We're going to go to the standard deviation channel, right click that, and we can hit edit properties. And if you see here, it says deviations 2.0. Well, that's a 2 standard deviation move, okay? That is not the norm. There's normally 3 standard deviations, 1, 2, and 3, okay? So the standard deviation that we want to focus on is the first standard deviation. So what we want to do is just click on this, and then take that to, actually just drop it down to 1. So this is a more narrower range, basically, what we're trying to get to. So it narrows the range, and this is the way that the stock normally should move. So this is its normal path. It should move within these ranges. And you see how I hit that top range and it never went past it? And then it dropped and it came down, and then it hit this bottom range and it went outside of that range. If it goes out of its normal range, then we go to another deviation, which is the second deviation. Okay? So that's abnormal. This here is abnormal. Everything in the middle is normal, so it can go up or down. The key thing to understand in this is that if you have a range, okay, the predictability is greater because I have a range versus not having a range. If I ask you to guess what number is in my head, and I have a number, I give you a range of 1 to 5, okay? 1 to 5, guess what number is in my head? You can go straight to the middle and say 2 or 3, and you're probably going to get it right. You're not a psychic or anything. This is statistics, right? That's just how you gauge this. The normal distribution is going to trade right in the middle. So 2 or 3 would be the logical thing to guess. And it's a high probability guess, right? So that means that you're more than likely going to get it right versus me saying, hey, guess what number is in my head? You don't have a range. Well, you're probably going to get it wrong because I have an infinite amount of numbers that I can do. It's kind of like, a lottery ticket trying to win a lottery. You don't have a range. The range gives you high predictability power. So when you have that range, it doesn't mean that it's going to be perfect, but it's going to be very high probable. And those 2 standard deviation moves and those 3 standard deviation moves, those are the outliers. Those are the abnormal things, and they can happen. So we saw it happen here, and this was in the market correction. This was a black swan event, basically, okay? This is the abnormal thing, and it can happen. So it's a good thing that it happened, that you guys can see it, okay? Because without it, you would never been able to see it or even believe it, right? But, yeah, that can happen, and that just happened recently as of this recording. So that's the standard deviation right there channel, where you can look at it on a chart, and you can actually see what range should this stock move within, right? This helps you to select better strikes and things like that, so you can get more specific in your strikes. So this is how you look at it on the chart side. Now, on the options chain side, let me show you guys that here. We go to the trade tab, and we're on our options chain here. Let me just drop this down so you can see. When we have the implied volatility numbers here, okay, you can see those. What's next to those you'll see is the deviation. This is the 1 standard deviation move that's already priced into it. It has a plus sign and a minus sign in front of it because it can go either way. But it gives us that range. If we take a look at our May 15th options here, we have 31.17. You could just round it to $31 price movement, right, on the underlying stock itself. So they're expecting it to move within a $31 range, up or down, positive or negative. Now, you can actually come over here, let's open this up a little bit. You can calculate this. You can add in the calculator right here. And then you can actually do the calculating. Now, I'm not going to actually even do that because it's not even necessary for you to even do any kind of calculation. But if you want to, when you're doing your analysis, you just add, the expected move, which is $31 to 284, and then you'll subtract it from 284, and that gives you a range. Okay? So you have a calculator that you can use there in your Thinkorswim platform. Now, another cool tool that we're going to use is going to be on the Analyze tab. So let me actually drop this back. Analyze tab. And then what you'll do is when you come to the Analyze tab, you can go to Probability Analysis, this thing right here. And then you'll go here and you'll type in your stock ticker, which I already have Apple here. And this is going to give us that distribution curve that you would normally see, the bell curve. You normally see it when other people are doing it. But again, I want to do it Wall Street Jack Boys way. So I ain't going to show you that curve because we already got one that's here, but it's showing you in the way that the stock price is going to be moving along with our expirations. So if you take a look, these dark blue lines here, they have the expirations of the options already on this chart. So you can see upon expiration where the stock price is going to be moving. Okay. This is Apple. This is its stock prices over here to the left. You can see the stock prices there. And this is its standard deviation right here in the middle. This blue line here, this blue line here. Okay, its mean is right here in the middle. This is where it's trading at right now. It's about 284. Okay, this is where it's trading at right now. This line right here in the middle. So if we take a look into the future, we can see the range that this stock is going to be trading within by, let's see, April 24, May 1st, May 8th, all right, May 15th, May 22nd. We can see all those. And you can actually change this to probability mode. You can change the probability mode to in the money or out of the money, which again, this is all helpful for our strategy selection. So certain strategies, we're going to be taking a look at in the money. Certain ones we're going to be looking at out of the money, what we intend for the stock to do. And so this helps us with our strategy selection. So we'll go in more detail in that. But if you take a look at this probability range right here, it says 68.27. Well, that is the standard deviation. That's the first deviation. That's the normal distribution that stock will move in. The probability is 68.27% that is going to move in that range. So that's, almost 70% probability. That is not 50-50. 50-50 is a coin toss. That's a gamble. We're not gambling here. We have high probability. We have the math on our side, 68.27% that is going to move within this range. And again, stock traders don't look at these statistics, but we actually do. Again, so that's why learning options is still an advantage for you if you want to trade stocks as well, because you can see where the market makers are actually pricing in the movement. So the first standard deviation. So if I go here and I click this I could change this deviation to the 1, the 2, and the 3. Okay? The 1 is the important thing here because this is going to be the normal distribution. And that's what you guys are looking at right now. Okay? So that gives us our range. So let's say May 22nd, let's say the May 22nd contracts here. Okay? We can see on the curve itself, this curve here, we can see the range is maximum out and is maximum low. Maximum high, maximum low. So by May 22nd, $326 is the pricing of that. And then the low is $241. So it's got the prices right here. You can actually see it. Okay. And the prices, the implied volatility is normally overstated. They normally kind of hype it up a little more. And so, just in case, right? But if you go right here in the middle, you already know what your range should be. It's a 68.27% that it's going to be at these levels. So we look here, we got $312, and we got $255 at its low point, right? But $312 at the high, $255 at its low. Let's go to the chart tab and look at that. $312, $255. All right. $312. Oh, what did I just say? Excuse me. $312. Okay, so $312. Yep, $312. About right here, and then $255 down here, about its low. So when we're choosing a strategy, it's going to help us to get within that kind of range. So you'll see within that range, 312 and then the 255, right? So we can see that that's in its first deviation. Let's go back. And then we can just click on this sigma, second sigma right here. Boom. And that's going to change it. Okay. We'll actually see these prices widen. Okay. Because it's factoring in more volatility. So the more volatility, the wider these ranges are going to go. And that's 95.45%. And then we click the 3 standard deviation. We'll see that it changes more. So I don't remember if I did the 15th of May or the 22nd. I think it's the 22nd. So we did the 22nd contracts. $439 is at its high, and then as low is at $179 there. So we know that we can encompass the entire move within this range, but that's just not highly probable for what we're doing. The wider the range, the lower the predictability power. So the narrower the range, the higher the predictability factor is. So we go to the 1 standard deviation. So you can see where this thing is going to move in, right? So we take it back, look at the 22nd May contracts. Let's see, 241, 326. We know this is the range here. That's the range there. And then we can also see the standard deviation right up in here between these lines at 255, 312 as of right now. So we can see that range here. So we'll go back to our options chain, and then when we get into our strategy selection, we can actually just clock all that in. We can look right in here at that 250 range and then that 320 range, right? We can see, right in that range is where this thing is going to be traded. So when we're selecting our strategy, we know not to choose anything outside of that, right? Because it's going to be highly improbable that that's going to happen. We want to stick with high probability. The importance of this is so that we can have the math on our side. We want to be on the right side of the math. The math is working in our favor when we use it. And so that's how you do it. That's pretty much it. So that's the standard deviation. It's just to help us with our strategy selection, to get proper expectation on where this thing could actually move. Helps us to calculate our risk, right? So we can understand what's at risk right now. And again, this changes throughout time. There's times we have high volatility and there's times we have lower volatility. When the volatility lowers, that range, it narrows. And then as the volatility expands, that range expands more. So it's a little harder to predict it as the volatility increases. So that's the lesson for today. Hope you guys enjoy it. Catch you in the next class. Peace.